All right, good afternoon, everyone, or good evening, depending on where you are in the world. So again, this is a day 2 of the onboarding, which I've done many times. It's a great way of filtering out your trades. You know, you can go get like a whole bunch there. You can get a whole bunch of trading ideas, and you're not exactly sure what their time frame is. But at least with this setup, you know exactly your time frames and how long you should be holding on to the position and how to manage it, right? And then this is not obviously this ideal trade setup. It's an ideal trade setup in terms of a filter, so you have at least some sort of reference of and consistency in how you're approaching your trades. But obviously, it's a combination of being consistent and also risk managing, which we talk about a lot in the focus session. And then in day 3, we'll cover the onboarding stuff. So here, if you go to the onboarding material, I've kind of simplified the process. So there's about 5 days where you begin on the 5th day to paper trade or live trade using the onboarding alerts. And then, but before those days, you want to get a good grip on, what does an ideal long trade look like when we look into a trade, and what your timeframes are. And then also, your position sizing, which is also key, right? Holy cow, mRNA is dropping quite a bit. And then your entry and profit taking, that's pretty straightforward, but it is good to kind of beat it into the head so that it becomes a mechanical part of your trading rather than a thinking process, right? If you think too much about something, then you probably shouldn't do it. If it's a no-brainer, so I'll give you an example of a no-brainer decision I made. Not trading related, but mentally. So I would go out and I would buy a $50, no, $100 bag. Okay, I bought a $100 camera bag, and I liked it. I liked it a lot, so I bought it. It was an instinct buy, so I bought it. And then 3 weeks later, I saw that same bag for 50% off, right? So instead of thinking about how dumb I was to buy it, I bought the second bag to reduce my cost. My cost basis into half, and then I just gave the bag as a gift to somebody else. So essentially, I averaged down, and that thinking process didn't take too long for me to figure out, and I just did it without even thinking. And you might think that might be frivolous, right? Because of the fact that I'll have redundancy. But, there's always people around me. There's gifts to give out, and it reduces my cost of my original purchase into half. And then I can give a gift to somebody else. So it was a win-win situation, and it was a good bag. So yeah, that's kind of like what we're trying to do here with the day 0 to day 5. Day 0 and day 1, this is obviously can be done on your own. So you don't want to, you don't need me to hold hands with you and go through these. These are self-explanatory. But day 2 is something that we're going to talk about today. So let's go ahead and pull up the day 2 material. So you go to onboarding here, and I guess you can click into the PowerPoint, and they all have hyperlinks. So when you log in, you can just click on day 2. So I kind of created a checklist so that you can go through it and make sure that you've covered all of them. And then keep in mind the session is being recorded, and feel free to ask questions so that this is not just only me talking. It would be great to also hear if you have any comments or feedbacks. All right, so day 2, this is the ideal long trade setup. So this is the image that I created. This is not an image that I found on the internet. It's the setup that we usually try to find among the sea of tickers. When I look at the setup and this image right here, I don't really care about what the company does. I do care about the beta, which is the amount of move that a stock price moves relative to the NASDAQ. So for example, maybe Roku has a beta of 5, which means that if the NASDAQ moves up 1%, Roku moves up 5%. Some of these things do matter when it comes to an ideal trade setup. And of course, they're not all going to work. The ideal trade setup is ideal in the sense that this is something that you want to be using as a filter when you think about your trade or your next trade that you get into, maybe going into a Thursday and Friday. I have some recordings here that you can look at, but I don't think it's very necessary at the moment. But yeah, this is what the ideal trade setup looks like on the right hand side here. So you get these two parallel lines. Color is not a big factor, so we don't discriminate. And then you see all these dojis. So I've kind of emphasized the doji part because dojis, in theory, is where the price between the buyer and seller is right at the at a sweet spot there. And when you get these big, thick red candles or green candles, you're not really quite sure where the sweet spot is because buyers may have been in control during that day and sellers may be in control in that day. And you're not really sure exactly what to make out of it. But with a doji, you don't have to worry about who's in control. You just need to worry about where it opens up the next day. Okay, so we're going to cover in day 2 just some of the main assumptions like the trading bias and then typical price action behavior that we would come to find in this type of ideal trade setup. And then we'll talk about our time frame selection, which most people already know. It's the 78-minute and the 30-minute. And those are the aggregation periods that I use or I suggest people to use for this type of for the types of trades that I take. And then we were combine it all together into modeling the data set using all of the information that's explained in this material. And then, and then putting it all together. Okay, so so these trades will identify a long trade setup and long meaning long calls or long puts. Okay. So when you speak with an option trader will say they have calls, but it's still the question is still hanging. Obviously, if you're so used to doing something over and over again, and somebody says calls, then you would assume that someone is long the calls, right? But when you leave the noun there, calls or puts, it's still the question still begs whether they're long or short. They're short the puts or they're short the calls, or they long the calls or long the puts. Okay, so this one is identifying long trade setups that are directional in nature in the north or south direction. And then topics such as position sizing, these things will not be covered in this in day 2. It's just day 3, day 4, day 5. We'll cover the topics, but only today we'll be covering just the ideal trade setup. So just want to make that clear. This fudge factor we'll talk about later. But the main assumption here is that if you look at the market, the long term, the way that the market has trended for the past, 50 years has been up. Okay. And then along the way on that journey up, you get a couple of dips. Okay. Maybe 20% of the time. So it's because of this fact, we're getting 80% bullish and 20% bearish. And we know what happened with the market last year. It's not probable for a bearish, like a market crash to happen in two consecutive years. Okay, so 2020 was a pretty big correction, not that big compared to some of the bigger ones we've seen in the past, but it was a correction of 20 to 25%. And then seeing another correction of 20%, 25% in the next year is not likely, because that would be a little bit more than 20% of the time, right? So it'll happen once in a while, but before you go into this, adopting this this ideal trade approach, you have to create an assumption, and based on my observation of the market, if you put on a logarithmic scale, it just goes up. Okay, when you put on anything on a log scale, it looks like it's just, especially the S&P and NASDAQ, it just goes up. Okay, and then along the way you get a couple of dips. So that's my main assumption. And I've talked to some traders that they ask question, well, Roger, how come you always buy, most of the time you buy calls? And it's because my assumption was stated at the beginning. I am 80% bullish, and I find it very hard to short such a strong market, especially a strong country. I don't think I would have problems if I was trading in other markets like in China and Korea. But even in that sense, I wouldn't be 20% bearish and 80% 80% bearish and 20% bullish. It would always be this. Okay, so this is something that I'll never change. Okay, so here let's begin with the typical price action behavior. So the way the Darvis channels work, which is what you saw back here, in the beginning of the slide, these two parallel lines, that's a Darvis channel, but these are just channels that are generated by price action. Okay, and then volume is also there that follows. But the price action alone will define the upper part of the channel and then the lower part. And what happens is you create a range, and 80% of the time the market ranges. Okay, so it's really brutal. I think today is kind of one of those days where it was ranging between 3 to 4 to 5%. So nothing has really kind of created another leg up. Like you might see in this chart that we have a leg up right here from the lower part to the lower part of the channel to the upper part of that channel. But then you can see in the next 3 or 4 days later, it's still within this box. All right, so that's consolidation. And then once we have this Darvis box that helps display periods of consolidation. And then within the consolidation periods, you can see, there's other methods that you can use for analytical purposes, such as BLT setups, candle over candle, dojis. They're all these different types of candlestick patterns that you can use to trade within that period. And of course, your time frame is going to be very important, especially when it's consolidating. Okay. So obviously you're not looking at this. If these are daily candles, you're not looking at it as a monthly time frame. You'd probably be looking at it on a day-to-day basis. So day trading to swing trading at best. So when you get into a consolidating period, right? And obviously this is this image right here of a breakout is not ideal. Okay, most of the time they do break out the way that we would like it to break out, but in this case you can see that sometimes you can get some nice fake outs, kind of like what happened to my Boeing position on Monday. So they dumped it pretty hard, pushing it through the UTL, which I'll talk about later, and then they kind of reverted right back up and filled the gap and pushed the price higher. So this is a breakout, and you get when you have your range defined and it's consolidated for a period of time, building up that momentum, that spring that some people use to kind of as a metaphor. The period of consolidation shows that there's an accumulation type of behavior or some sort of price behavior where it's not moving higher or lower. Okay, and all we can really do as traders is to kind of look at it and say, okay, it looks like it's making a higher low or a lower high, and then maybe use other methods of candlestick analysis like the Hikinashi candle, which will help you identify the centroid of each candle, showing you the moment of inertia. Because once the moment of inertia starts picking up, then it becomes a lot more directional in one way, right? But yeah, when it consolidates, you want to know where your upper and lower part of the channel is. And then once you identify that, you can take some positions on the breakout or breakdown, and then manage risk according to your risk management rules. So the simplest risk management rules is close off half at 100%, and then let the rest go to zero or max profit, whatever it is, right? Okay, so this is an ideal type of trade setup. However, sometimes, okay, ideal doesn't mean it's the best out there. It's not a panacea to becoming a millionaire. It's just one way of introducing consistency so that you can become a better trader. And I believe if you follow these instructions and master this one simple filter, kind of like how you filter your friends and stuff like that, you know, how you kind of look at your food to check out reviews on restaurants. You want to have a filter, a go-to, where you kind of review the trade based on what you've been using over and over again, so that things are consistently done. And when you introduce consistency, then you are introducing a trading behavior that has a higher probability of winning more often than losing. Believe it or not, when you go to the casino and you get odds where the house has an advantage over the gamblers, there are a few gamblers that are still able to make it out of that casino with a decent profit, but it's not everyone. It's definitely less than, it's a very few set of people, but it is possible and probable that a handful of people will come out of the casino with some profits. But and that's with a less than 50% probability. Okay, even worse, probably 30%. So if gamblers can do it with 30%, then I'm sure with traders, when you introduce a model, a trading pattern, using the tools that I'm going to outline here, you'll introduce some consistency that will push your probability of success above 60%. And that's a 60% with a profit factor of whatever profit factor you find. Okay, so generally when you get a profit factor of 10%, you're not really going to be taking that type of trade, right? With options, because of its leveraged nature, we want to look for 100%. I feel, I don't know about you, but when I pull in a 30% winner, I kind of feel a little bit bad. Okay, because there's always 100% winners in the market. There's a lot, right? And because we are option traders and we have risk management techniques to kind of mitigate the drawdowns, such as, you know, position sizing, we can afford a couple of hits, right? Not too many, but we can afford them. But you know, with 2,000 companies out there, I don't know why I would put so much of my energy looking for a 30% win, right? I want to look for those big wins, 100%. You know, the one that Bags pulled out on mRNA, and maybe he might be pulling out one on the puts too. So these are things that you want to keep in mind. Like when you get into an ideal trade setup, there's a couple of things that you want to look for, not only just the pattern, but also is the risk and reward worth taking? Does the ideal trade setup pattern look good? And does the risk and reward make sense? Because if you're looking for a risk and reward of risk one to make 10%, 30%, you need to change up that mindset and look for something bigger. Okay, so you're going up to bat on the diamond, and the pitcher is right up against you, and you're looking for a home run. Okay, most of the time, RBIs are good. Don't get me wrong. A lot of baseball coaches always encourage people to hit RBIs, right? But you know, there's always that one batter that comes up and cleans up. So you want in terms of options, that's what you're trying to do. And think about it, like when the designated hitter comes up to bat, he's not the one who's coming up to bat on the first attempt, right? He's not the first batter. He's usually positioned as the third or fourth batter. Okay, like our cycle talks with A6 and A7, we talk about cycles a lot when we talk about Ttm squeezes. So 3 or 4 and all that stuff all kind of makes sense. I almost feel like the people who made the market almost like love playing baseball. All right, so let's go to the time frame selection, and basically I'll just keep this pretty short. There's a macro, micro way of approaching these things. Some of the biggest moves came from the A8. If you're not familiar with A8 or whatever, what I talk about, A6, A7, A8, these are referring to not the car I drive, but the time aggregation period. So monthly is A8, weekly is A7, and daily is A6. So you can think of it like the daily A6 is 6 days. The market's open 6 days a week, right? It opens on Sunday. And then 7 days a week is weekly. And then by just deduction, monthly A8 would be in monthly, okay? And some of the biggest moves that we've seen happen off squeezes off the monthly time frame. And then if you combine that in with like, if you can see it, you probably see like an ideal trade setup that was developing with that A8 in mind. But these are macro, and these kind of help you understand the direction of them, of the selling pressure or the buying nature of each underlying. So we did that today, this afternoon with Roku, and we looked at Roku. Roku's been dumping quite a lot, and I think it's down 21% after earnings. And it could continue moving higher. And we looked at the daily time frame, and it still looks like it's under some selling pressure on the daily time frame and weekly and monthly. In terms of day trading and swing trading, especially for swinging, like opening up positions 10 seconds into the close, which I'll talk about in another day on entry, we use the 78-minute time frame and the 30-minute time frame. So they'll tell you why. The first one, the 30-minute time frame with the after hours off, okay, the reason why is because I've created a system that is anti-fragile in nature. It wins all the time, okay? There's a reason why we have a lot of people coming in and pouring their money into the system, because it's a no-brainer. It'll make you rich, okay? And all you got to do is just make sure you're alive and healthy. But through all the research that I've done so far, the 30-minute time frame with the after hours turned off is the most reliable in terms of automation. So knowing that gives us an edge in terms of which time frame we should look at the most often. So if you find yourself that you're looking at the 1 minute time frame, or even on TradingView even has like 1 second time frame, you are probably going into much detail, right? Micromanaging, for instance, do you guys like to be micromanaged? So if you like to be micromanaged, maybe the 1 minute time frame or the 1 second time frame makes sense. But in terms of reliability and making decisions every single period or frequency, it's the 30-minute time frame is the best, okay? And then wherever you are on that 30-minute time frame, you can drop your time frames to something lower, like the 1 minute or the 3 minute. But you know, as your go-to when you're looking for entries or day tradings or whatever you're trying to do on the lower time frames. But you have to kind of create an anchor, an aggregation period anchor. And I suggest using the 78-minute and the 30-minute. And especially for the 78-minute, you should use it with the extended hours on, just so that you can incorporate all the data that's being processed after the market closes and before the market closes. And this is all that junk material that's happening after the market closes and before the market closes. That's still data. You can't remove it, because you can't remove it just simply because you think that you can't trade it. People are still trading after hours, but you can't remove it, and it's still important data. I used to do that when I did my design. I'd say, oh, I don't need this garbage data. And sometimes it's really garbage. Like, you'll know it's garbage. For example, when I was younger, I was pushing probes into the ground, and then I would hit bedrock, right? And I'd push and push and push. And we know it's bedrock because it's not going and the rig is lifting and all that stuff. We're just putting, 10, 15 elephant pounds of force right into the ground just to make sure that it's bedrock. And then the data becomes junk. You'll see the data and all the data points coming up as junk. Okay. We don't remove all of it, but we know, like, how much junk of data do we need? We don't need it all, but we know it's there, and we don't want to remove it, because once you remove it out of your logs and somebody looks back at it later, you don't know if there's bedrock. If you remove the bedrock layer from the data set, then how would you know there was bedrock there, right? You'd have to take a guess. So you leave everything there. All data must be considered, okay? Now, some people ask me, well, why don't we use the 30-minute extended hours on for the algorithms? Because the algorithms can't, the way that I program the algorithms, they can't buy using limit orders. Limit orders is a little bit different. So, and a lot of the price action after hours is there's a lot of gaps that happen, and the volume is really low. So you're not even sure if you're able to pick up the amount of shares that you want to pick up. Anyways, those are the aggregation time frame periods that I would suggest you using. And then if you drop down into a micro level, say that something where you want to trade with the after hours off, or sorry, something where you're day trading or scalping, you want to drop down your time frames down to 15-minute and 3-minute. And you might be asking, well, when do you not use the extended hours or the after hours? You don't use it after like the last 2 hours of the day. So because all the price and all the stuff that they were going to do at the beginning of the day before the market opens is already done with after the first 2-3 hours. And then in the last hour or the last 2 hours or an hour and a half, the after hours from the previous day doesn't really matter. Okay. So then you can now change your period. You can change your aggregation period such that you are considering a lower time frame with the extended hours turned off. All right, so we've talked about the aggregation period that you would want to use as your anchor. So then you might be asking, well, 78-minute and 30 minutes seem to be the anchor, but what about the daily, monthly, and weekly? Yes, those are also anchors as well. And you do need to look at the macro picture of things on those periods of time, daily, weekly, monthly. But in terms of a swing trading, okay, then you want to use in identifying ideal trade setups, you want to use the 70-minute and the 30-minute as the go-to. Okay, so you can find ideal trade setups on the daily, weekly, and monthly, but then you need to also consider, how long it takes for it to develop. You won't be, I don't think if you get a monthly setup, you don't want to buy something that expires on Friday in one day, right? You want to go out a couple of months, 3 months out, maybe 6 months out on a monthly time frame. So it's all time dependent. But the 70-minute and 30-minute are great, especially the 78-minute. And then when you're modeling the data set, moving on, we need to have a couple of indicators. So one of the indicators that we offer to all members is the toss option algorithm. And this algorithm is the algorithm that's running all of the portfolios that I'm managing. So believe it or not, the portfolio that we managed back a couple of years ago was only at like $300,000. Now we're almost at 6 million. Okay, it's crazy. I can't even believe how far we've come so far. But this toss option algorithm, we've converted it from TradeStation into TradingView, and this is something that you want to have as your like a electronic consultant. It's the one that's going to give you the best way of reading the tape. Okay, so you want to have that, and everybody should have that. And you can go through, like if you just go to the the charts here under indicators, it's this one here with the lock sign. So if you don't have that, then contact Andy Wall Street to get that in there, and then you'll see all these beautiful colors up here. Sorry for the coughing. All right, where was I again? All right, so then the next one is you want to have the Darvis channels, the Darvis box or the channels included. Okay, so that's already covered in day one, and you should have those installed. And what they look like is they look like these purple and yellow parallel lines. If you click on here and type in Darvis, and I think it's simpler trading Darvis right here. Yeah. Then you'll have that. See, when you have it, when you don't have it, you can't see where periods of where the price has been consolidating, right? But then when you add it in there, you can kind of read the price action a little bit better. Okay. And this is important because when you look at it with nothing and it's just naked, it's you believe it or not, these candlesticks are pretty damn tricky. They do these mind tricks with your head. I don't know if you've seen those mind tricks where it looks like the staircase is moving in a circle and moving higher, and then somebody's walking, but they end up being flat. You know, those illusions. That's what these candlesticks do very well. they create an illusion. So in order to avoid being mesmerized, you got to place some sort of horizontal or vertical images in there to make a reference of what these prices are doing, these candlesticks are doing. Because when you do that, then the illusion becomes not an illusion anymore because you got a reference. So this is important to have. And once you have a reference, things become a little bit easier to read, and you can start to find those setups. Okay. Sorry. All right. So let's moving on. So once you get your algorithm, okay, that's back tested. We've back tested all of them. They have, it's not an indicator. Okay. An indicator, when you get an indicator, it means that that indicator has default settings associated with it. The toss option algorithm does not have default settings that it uses for all the tickers. We've actually put in specific values that we've back tested into the script there, and because we did that, it is more of it's an actual almost an algorithm. There is a slight delay because you're using a 30-minute time period, so it's not real time in that sense, because real time would be second to second. And that's where the opportunity comes in, when you're able to find the trades where the algorithm's transitioning from a long to a short or a short to a long. Okay, that's where the big money is made. And hence we try to get into the positions before the move. Okay, I'd rather go through a drawdown anticipating the move than chasing. Chasing really sucks most of the time. All right, so we got Darvis channels. We cover the toss option algorithm. And then keep in mind, this toss option algorithm is designed strictly for the 30-minute time frame with the extended hours off, but you can also use them when they are on, but you need to apply the ideal trade setup as you are, looking through the markets for opportunities. The third indicator, which is the indicator that's used by almost every single option trader in the world, is the Ttm Squeeze. Now, if you haven't used it and you're saying, Roger, I don't know, I'm an option trader and I've never used the Ttm Squeeze. Well, in some form or some factor, you did use it, you just didn't recognize it. So this is a Bollinger Band in there. And what we recommend is using the Ttm Squeeze with two settings, where you have to modify the default setting of 20 into 14. So we put on two Ttm squeezes, and then one of them is the default, and the other one is the length where it's set to 14. So if you look at here, we have this Squeeze Pro that we added. This is free. And if you double click on it, it's not going to show you the presets, but it's the default setting here is 20. Now there's another one here. I don't know where I got this one from, Squeeze Mom Monique or something. And what you need to do here is they have the input settings set to 14 for both the Bollinger Band and the Keltner channel. Okay. And when you do that, it will help you identify periods of what is it called? What's that word? It'll give you like a double confirmation. So for example, like here and here, you can see that they're both scanning. So that means that, this is the bands are now have been contracting a lot more. Whereas when you get into periods like this, they have not been contracting on the larger length period of 20, whereas on the shorter length period of 14, they have been contracting and possibly showing bull flag potential. So these are, for continuation patterns, the default setting of 14 will help you identify continuations as price continues to move higher. Whereas the default set to 20, it won't be able to capture all that because its length period is at 20. So it's looking at the last 20 candles on that period, whereas this is looking at the 14 candles. And the 20 and the 14 create a 6 length window that you won't be able to identify. It's like a bandwidth filter. And you'll be able to look through each of the periods from 20 and 14. And there's a window of 6, length 6, that we're tracking here. And that's what we're doing when we introduce both the two TTM squeezes. And then finally, we have a MACD, or you can use a full stochastic. Basically, these help you identify the gradient of price. So you can use either the MACD or full stochastic. It doesn't matter which one you use, but all we'd use it for is just to kind of know, when it's extended like this, and that make sure that the gradients are positive rather than negative. Because if it gets negative like this, then obviously it's moving lower, right? And then when it does this extension, then that might be a buying opportunity. You're just looking at they're cyclical in nature. They call these oscillators. They move up and down around 0, and that's important to have. And we use those just to identify the gradient. So if the gradient is positive, then you want to be in that trend of the gradient. And then when the gradient starts to pull back, then you want to monitor how it pulls back as it's kind of flagging here. Okay, that's a bull flag. But yeah, it doesn't matter which one you use. I think MACD is good. MACD is also described here with these histograms. It's just the slow and the fast give you a better idea of how price is extended away from each other using a moving average approach rather than a price moving average approach. But you need to be able to differentiate the two in real time. Okay, and then so add these. So in day 1, you should have added these, and you should have everything all set up. And then here's a little bit information of the modeling of the data set. So we use those back-tested algorithms in there, and this is just an example of the back testing. And we take into account almost everything. We take into account seasonality. So here's Tesla's average profit month for the past 7 years. It looks like it's supposed to be doing very well in August, and that's for TGIF. And we have all the data sets here showing the metrics of the algorithm from its past performance. So probability of success is around 57%, profit factor is 1.8. And then here's the equity curve for the algorithm. So that was last year, actually. So that was a one-off. Like I showed you before, the algorithm is very straightforward. It's color-coded to give you ideas of when it goes into a sell short position, long and neutral. Keep in mind, this algorithm was designed for common shares, not for options. So option traders, we piggyback. We're derivatives of the common shares. We are time sensitive, so we need to be more sensitive to how the algorithms are used in our trading approach, right? So because options are derivative in nature, they have a time component that's decaying. We have to be very careful with our timing. So that's why I always talk about 10 seconds into the close. That's literally when all the things are literally shut down. There's no more decay, no nothing that you need to deal with. You just have to kind of see if you got an ideal trade setup in your favor. So these are algorithms that are designed for common shares. You just got to make sure that you understand this is an apples to orange comparison where we're using an algorithm that's designed for common shares. We trade common shares like we trade options. We're buying 100 shares, okay, which is one contract. So that's essentially the ideal way of trading. You want to trade enough shares that you're literally trading a number of contracts. But when you don't have that luxury of trading that many shares, then you have to resort to trading options, right? Because options still give you that leverage and they give you a nice bang for your buck, but then you need to be a little bit more sensitive to some of the dangers involved, such as the theta decay. And hence 10 seconds into close is one way to avoid it. Or opening up a position at the bell. All right, so going back to modeling the data set, once you have the Darvis box and all those things incorporated into your TradingView platform, then here's like an example of a Darvis box, and it is a tool. I don't think it's really an indicator, but it's a tool that helps your brain to eliminate the illusion effects. You can easily be mesmerized and think that the price is moving in one direction, but then all of a sudden see it moving in the other direction. So you want to have something that's vertical or horizontal to keep things in perspective. Because if you don't, then you're just going to be guessing. So this is you can, if you want to read up on the Darvis box theory, you can read it up here. But basically, all we want to know is which way it's going to break out, above or below. And then, if you're interested in knowing what the yellow and purple is in terms of like its importance, yellow means it's in a trend higher, making higher highs, and purple means it's making lower lows. Okay, but we don't differentiate between color or discriminate. So the yellow Darvis box or channels are generally bullish. Okay, like I said, it's a higher high. Things that moving higher will show yellow Darvis channels generating day after day after day as it breaks out. But it can break down. So nothing is perfect. Doesn't necessarily mean that you have a Darvis channel that's yellow. It means it's going to break up. Okay, there's still some things that you have to pay attention to in order to increase the probability into your success. One way is just using a Hikinashi candle. But anyways, identifying 3 points of contact at the bottom range of the channel is one way to consider a long position. And I put these points of contact just as a reference, as an ideal situation. So usually you don't get something this flat. Okay, you usually get a higher high or higher low or lower high. Higher high, higher low, or a lower low. Okay, and that's what you're using those vertical lines for, to differentiate whether the price action is being showing higher lows or lower highs, and then maybe filter it using a Hikinashi candle to kind of know where the momentum, the centroid is of the candle. And then once you have that set up and you see it kind of forming in front of your eyes, then based on maybe the centroid, or based on the market conditions and based on what day of the week you're in, then you would make a decision to take a long position or a short position 10 seconds into the close, anticipating the next candlestick to be a nice big green or big red candle, depending if you're long puts or long calls. Okay, and then you usually want to get in before the move happens rather than after. Okay, and that we'll kind of talk about later. So here's an example of a chart that shows the toss option algorithm long. So the long color there is cyan. And then you can see the parallel lines here and here. And then here's the theoretical one that I was just showing you on the front page of the slide. So here at the top, you can see two parallel lines, and you can see that the price continues to kind of trend, right? And it's been trending and trading sideways for a long time. This would be brutal if you're holding a trade that expires on the weeklies, right? They would all go zero. But eventually it did break out. And I don't have the full picture here with all the indicators underneath. But if you caught the trade here or here, and then your profits start to come in on the third candle, then you're laughing to the bank, right? And that's this little part right here is exactly what option traders want to get into. Not on the day of the gap, the day before the gap. Okay, so that's that's a very straightforward image. And then you can see after it consolidates a little bit more, it rips up higher, and then it consolidates again, forming another Darvis channel. The image here is an image of Tesla in a purple D. And I think right now, Boeing is in a purple D on a 30-minute time frame. This purple D is on the daily time frame. Okay, so purple Ds are generally bearish in nature. But if the price of the underlying decides to continue moving higher, then you get a short squeeze. Okay, because right now, the majority of the algorithms that are running in the markets are looking at this stock as a very, very bearish bias because of the math that's involved to create this purple D. So if this purple D is forming mathematically, then there's going to be a lot of other systems out there that are also going to use a bias that's very similar to this, this Darvis purple channel. But as when we look at it into a little bit more detail, we can see that the candlesticks are showing that it's trending higher, making higher lows. Okay, so then we would have a bias. We would introduce a bias based on the price action that's developed over the past 3 or 4 months. Regardless of the candlestick pattern for the past 3 or 4 months, the overall trend of this chart here is still showing a negative bias, a bearish bias. So if the price decides to break out of this purple D, maybe on news, then you get a short squeeze. And those are epic. So that's what Boeing is setting up for. And maybe that might happen on a Wednesday. Here's an example of main server 103. These are all algorithms running toss option algorithm in real time. They're all automated, and they follow about 8 tickers, and you can see all these purple Darvis channels forming right here, right? And then if you're able to catch these, you get a pretty big squeeze that develops. Okay, there's a Roku one. I don't know which day what this is. March 31st. What day would that be? Would I be brave enough to call it on a Tuesday? Would March 31st be a Thursday? Wednesday. Yeah, Wednesday. So now one day off. So here's a zoom image of PayPal, and you can see there's that purple D hovering around the UTL, which is the unique moving average for the specific underlying, and then you get the Ttm squeeze that's basically showing that price has been trading within a range. So when you get these red dots forming, we call it. Some people call it squeezing. I call it scanning. Because during this period, you should be looking to scan every single detail of this particular pattern that you learned from the ideal trade setup, and keep on relooking at this price action to figure out whether this is going to be a purple D that's going to break out in short squeeze or break down. And you can see with this MACD here, or I think this is a stochastic, you can clearly see that the gradient is positive. You won't be able to see quite clearly where the moving average is here in the Ttm squeeze, but you can kind of see a little bit. It's popping up above the 0 line. And you can see that the price action of each 30-minute candle is making a higher high and trying to push through the upper purple D there and then break out. So we call this purple D. Okay, so if I say yellow D or purple D, and then note the time frame, 30-minute daily time frame, 70-minute time frame, whatever, then you know that it's probably better not to open up a position during the day, but rather at the end of the day, because you see what happens at the end of the day, it closed slightly higher and then it pulled back to 237, I believe. And then on the morning, it popped up. Okay. And that pop from 237 to 244, that's like a 200 to 300% win on an option trade if you take weeklies. Okay. So think about that. That's a lot. That's a lot. And if you catch enough of these, you're going to be, and you're consistent with the setup, you're going to be doing very well. Okay. Now look at what happens if you buy something in the middle of the day after the first, after the 60 minutes has passed. You're just going to be holding on to that contract with DK throughout the whole, 6 hours or 5 hours. So you're going to DK 5 hours worth of premium in that contract and then make a profit. So why not just wait 10 seconds into the close and catch that immediate profit? You could do a lot during this day. So when something is squeezing, that's the other term that people use, or showing a red dot, that's the period where you want to look for these ideal trade setups forming. And they generally do form at the end of the day. And then we take advantage of the rush hour in the morning. And hopefully if the markets are green, then and we're long calls into the close, then we should see profit develop. And that's what we did with the BYND. Did anybody get the BYND here? I don't know. Did anybody make profit on that? Spotify, we didn't, but we cut those loose. But BYND was pretty good. We'll talk about, I'll just maybe look at it together quickly here. So BYND on the 30-minute. Yeah, right here. This is BYND. So I just got in right here. Can you believe that? That small little move. The small little move from here to here, from 129, 130 to 134 was 100% return. Okay, and it did have a purple D. Okay, unfortunately, it didn't follow through. And I guess maybe because it didn't have a 30-minute Ttm squeeze that's showing here. So that's something that you can, I mean, we had an edge that Tuesday, it was going to be a little bit, it is going to be bullish. Okay, a little bit bullish up until 10:30 a.m. And then everything started crashing, right? 78-minute time frame. There was nothing here on BYND. And then I think we're chasing after the A6 here, right? So the A6 was another motivation for us to get into the position 10 seconds into the close, looking for a breakout above this 134 level. But the momentum, quickly went the opposite direction. And now we don't even know what's going to happen, right? So you can see right here, there's a purple D, and look at the price action, right? You can see that the price action is just not showing that you're going to get that short squeeze setup from this example here, right? We wanted to make it higher highs. Like if we look at, let's take it, I think Boeing has it. See, Boeing is pushing up. And it almost looks like actually BYND, but this one is Boeing on the daily time frame. Look at BYND. It's like almost exactly the same thing on the 30-minute time frame. Oops. Right here. This part right here. That part right there looks like Boeing, but on the daily time frame. You got the purple D, high and tight with the in the upper channel. And if we type in Boeing here on the daily, see? It's the same thing, but different time period. So I wouldn't be surprised to see Boeing break out tomorrow on Wednesday and then pull back like it did with BYND. That's something that would work. And let's look at the other time frames. 78-minute time frame, nothing there. And the 30-minute, nothing there. So there's actually nothing there. Maybe something maybe on the 15-minute. Yeah, the 15-minute looks like it's got something that could pop it up a little bit more. But I'm not in it because, I mean, I was in it, but I closed it out because I had weekends. Anyways, Going back to the presentation, that's the purple D, okay? That's what you're looking for, and that's what you want, okay? That's the ideal trade setup. We don't really care about the color too much, but we should pay attention that purple Ds can display huge short squeeze potential, whereas the yellow Ds, they can also move as well, but that's the only difference other than the sentiment and the squeeze potential. They're all the same. Okay, it's just the setup. This is GameStop on the left-hand side, and you can see that it looks exactly like PayPal, right? And I think this GameStop might be on the daily time frame, so it doesn't really matter. I don't know what it looks like now. Let's see if I can find it. GME on the daily. Right here, right? Look at that. That's the squeeze. Right there. So you have the earnings, and then it just breaks right through. And that one really squeezed hard with that bearish engulfing candle. It's brutal trading action. Okay. So TTM squeeze, you may already know this. I'm not going to go into it into too much detail, but basically it's pretty straightforward. It's a combination of Bollinger Bands and candle channels, and it's going to help you understand whether something is consolidating or breaking out. So when you might be confused. You might be saying, well, Roger, are you double dipping with the Darvis channel? And because the Darvis channel isn't that supposed to show periods of consolidation? And yeah, I agree that the Darvis channel is doing pretty much the same thing as the TTM squeeze, but the TTM squeeze formulation is calculated a little bit differently using two indicators that are essentially overlapping within a certain standard deviation. So the price range that the TTM squeeze shows is a more it's a refined it's more refined to a tighter period of consolidation, whereas the Darvis channel is developed based on pure price action. Okay, so if something rips up and then dumps, that initial rip will create the upper channel of the Darvis, and then as it pulls back, it'll create the lower bound. Whereas the TTM squeeze, it'll just monitor the highs and lows of the candlesticks from the last 14 to 20 length period. Okay, so this is important to understand. So in this case, when you were double dipping in periods of consolidation, I think that's a good thing when we're double dipping it, because you can get a lot of consolidating periods on several different time frames, and we want to just capture as much as we can, especially using the periods that we suggest you to use: 70-minute, 30-minute, and A6. Okay, so and the color of the dots don't really mean too much. I think they call it I don't know, like a high squeeze potential or something. It doesn't really matter. It's all the same. Okay, if price is going to move higher, it's going to move higher. You just need to manage your risk. So that's about it. So the TTM squeeze, a macro approach, would entail using TTM squeeze on a daily time frame, and then using cycles or some sort of exit approach to manage your risk as it continues to move higher, because nothing just goes up in a straight line. They do tend to pull back and consolidate before it makes another leg up, forming a bull flag. TTM squeezes have unique ways of representation. So because there's so many different types of aggregation periods you can be moving in and out of, we use those periods and call them units of cycles. Okay, so if we go into daily cycle, 70-minute, daily time frame, 70-minute time frame, 30-minute, they're all represent a cycle. Okay, you just need to be specific about which time frame you're using. So if I go, hey, let's pick up this position on the A6, it's going to enter cycle 1. So when I say that, then okay, it's going to enter cycle 1. So that means I've got to wait till cycle 1 triggers to see any profit. And then on cycle 2 and 3, I can look to see some pullback or profit taking coming in. So if something triggers on cycle 1 on A6 on Monday, then on cycle 3, which is supposed to be profit taking day, then that would be Wednesday, right? So I kind of know in advance when I should be closing out the position or managing it in between cycle 1 and 3. Now, if I go down to the 1 minute time frame and I say I'm in cycle 1, then everyone knows that I'm going to be in that trade for no longer than about 3-4 cycles, which is 3 or 4 minutes. 30-minute cycle, then 30-minute time frame, I'm going to be in that period position for no longer than 90 minutes, right? And 70 minutes and so forth. So here's an example of Ttm squeeze that triggers time cycle 1, and then you can see what happens after that. You can see that as it breaks out of that Darvis channel. Okay, so here it didn't trigger cycle 1; it's still scanning, but you would have made a lot of profit on that initial move, especially in options. That would have been like a 200% move, maybe 300, depending on your weeklies or if you bought 7 days out. And then when it actually triggered, it actually made another move higher, and then on the 4th cycle, that was the high. And it's not always the case that the big move happens on cycle 4. That's something that we will never know. Okay, all we can do is just manage. So we'll talk about the managing part later on in day 4. But if you get into this position, and again right here, maybe if you identify a launch pad here, and then you're up again another 100%, you just close off half and see what happens on cycle 3 and 4, right? Easier said than done, right? Okay, and then here's the full stochastic, and basically this is just showing the gradient. So making sure that the trend, you're still understanding the trend, and you're not losing focus or bringing in negative thoughts that the market's going to crash. The trend is your friend until proven otherwise. And before I end this conversation, this is an ideal trade setup on stamps. So look at Stamp here. So Stamp showed this massive yellow D with an A6 right into the cycle 1 and 2, and then it gapped up like 60-80%. So this is some of the things that you want to look for. And you look at that. So it started forming the Darvis channel like a long time ago. And then finally, it starts to form that A6 going into earnings. And then you could have taken that risk where it could beat. And if you did, with just one contract, it could have been a life-changing trade. All right. So this is the setup that you need to kind of master. Okay. It's the base, it's the foundation, and it will help because not only is it consistent, not only is it going to introduce consistency, but it's going to also improve your understanding about what you can do in certain situations, like when you develop profit or you're going through a drawdown. You'll know what to do because you've seen the pattern so often, so many times. And this is the key into trading. It's just trading something that's consistent, works, and you know how to handle it. And I don't think this is all. You still need to know Kelly criterion to know how to manage risk, but this is one of the biggest things that you need to understand, because everyone's got a way of trading, right? Depending on how much profits they have and how they feel. But when you introduce consistency, there's no feeling. It's the same thing over and over again, like a 9-to-5 job. You might be pretty sick of it, waking up at at 8 or 7, going to your job, checking at 9, leaving at 5. But when you keep on doing the same routine over and over again, there's no feeling. You're just in and out, in and out, in and out all over again, right? Okay, so that's the end of today's ideal trade setup. I hope you learned a lot from this. Does anybody have any questions that they would like to ask before I close this session? Don't be shy. If you feel like you want to ask a question and say something, then raise your hand and I'll unmute you. Otherwise, if you learned enough for today, we have tomorrow a focus session on Wednesday where we'll talk about the Roku trade. So Roku trade is the strategy called TGIT. And basically what I'll be doing is I'll be looking to see if I can find an ideal trade setup, maybe on the 30-minute time frame, maybe on the 78-minute time frame. I don't know. We'll just have to wait till Thursday. We got one day between now and Thursday. That's Wednesday for a price to kind of develop. But we will talk about Roku on Wednesday because it's got a very nice clean setup with some very nice targets that are setting up for a move back up to 500. Not this month, but I think September. Okay, so thank you very much for your time and enjoy the rest of your day.